understanding the stock market is important when it comes to retirement planning. So here to explain what you need to know, I'm joined by Julie Newton from the Market Advisory Group today. Good morning, Julie. How's it going?
Great. Good morning.
So, Julie, the stocks have been on the rise lately. So what exactly does that mean for retirement planning?
Well, so first of all, it's a wonderful thing to see those numbers start going up. And I don't mean to downplay that at all, but now isn't the time to get really super comfortable. One of the biggest mistakes investors make when they see that stock market start to rise is to get complacent. But now is sort of the time to take stock of where you were. What did I lose? Did I lose 10, 20, 30% in the last 18 months? Was there one investment that performed better than the others? Can I afford to lose 10, 20, 30% again? And when was the last time I talked to my advisor? So even though we see those little ticks up, it's time to sort of plan for that next downturn, whether it is next year, 3 years from now, 10 years from now. Planning is the key.
Okay, so how would you describe the first half of 2023 in the world of investing?
You know, it's kind of like, I would say, how a Chiefs fan feels waiting for the Super Bowl and are we going to get through that? Are we going to win? It's sort of like holding your breath, waiting to see what happens. I think that a lot of people still are feeling that way. Is the market going to go skyrocketing, or is it going to hit the bottom of the canyon again? So it's just something that people are very hesitant. Typically after a downturn, we see a lot of optimism and people are rushing into the market. But this time, with all of the concerns throughout the world, people are still holding back with that pessimism. They're still kind of waiting to see what's happening.
Okay, and are there any pitfalls in the coming weeks that people should be looking out for?
One of the biggest pitfalls, ironically enough, is those high interest rates that we're seeing on things like CDs. So the average person, you know, they're looking for that safe haven kind of place that they can put a bunch of money, you know, sort of again with that pessimism that they have right now. And so they're jumping into those CDs, which the rates are great, but what they have to take into consideration is that you pay tax on those CDs on that interest in the year you earned it. So if you are somewhere at like a 22% tax rate, you're only keeping 78% of that interest. So you're actually getting a 3.9% interest instead of the full 5%. And of course, the other piece of it is if you're earning Social Security, taxation is going to be driven up by the interest on those CDs. So it's a good time to work with a financial advisor and a tax professional.
Ask Our Advisor on Kansas City Spotlight has been paid for by Market Advisory Group.